Namaskar. I am Ishwar Rathod, Assistant Professor GS Class 2 in Accountancy at Sri K.K. Sastry Government Commerce College, Maninagar, Ahmedabad. I am going to deliver my presentation on leverage a conceptual framework. Leverage means a fixed cost are paying a fixed return for employing resources of or fund. According to Shell and Haley, the business unit tried to get more profit by using finite expenditure or security with fixed burden. It's called financial leverage. Type of leverage: first of operating leverage, second financial leverage, third combined leverage. First of financial leverage is, operating leverage is in the business. Certain expenses are fixed. Due to these expenses, operating profit increase more of comparison with increase in sale. It's non-operating leverage. According to Izura Solomon's, operating leverage is tendency of the operating profit to vary this opportunity. This is for the table of find out of operating leverage. First of sales minus variable expenses is equal to contribution minus fixed cost is equal to earning before interest and tax oblique operating profit minus interest is equal to earning before tax minus tax is equal to earning after tax. Formula of operating leverage is equal to contribution divided by EBIT. Financial leverage. The use of security with the fixed burden in company's financial structure is called financial leverage. According to Khan, the use of fund with fixed burden like debt and preference share capital along with the equity capital in capital structure is said of financial leverage. This is the table of find out of financial leverage. First of sales minus variable cost is equal to contribution minus fixed cost is equal to earning before interest and tax minus interest is equal to earning before tax minus tax is equal to earning after tax. How to find out financial leverage? The formula of degree of financial leverage is equal to earning before interest and tax divided by earning before tax. Third of combined leverage. When operating leverage and financial leverage are considered together, it is a non-combined leverage. The effect of fixed operating expenses on the product sales and the effect of debt with the fixed interest on EPS. How to change in sales will affect of the EPS. This is a table of find out of combined leverage. First of sales minus variable expenses is equal to contribution minus fixed cost is equal to earning before interest and tax minus interest is equal to earning before tax minus tax is equal to earning after tax. Find out of combined leverage equal to degree of combined leverage equal to C divided by EBIT. Another formula is a degree of operating leverage multiply degree of financial leverage equal to degree of combined leverage. For example, suppose unit of 10,000 and unit of 11,000. Sales price is per unit 10 rupees. So sales value is 1 lakh and 1 lakh 10,000. Variable cost of per unit 4 rupees is equal to 40,000 and 44,000. So sales minus variable cost is equal to contribution. So 10,000 is 60,000 and 11,000 equal to 66,000 minus fixed cost. The fixed cost are fixed for all unit is at 20,000 for both is equal to so EBIT operating profit 40,000 and 46,000 minus interest 20,000. So earning before tax is 20,000 and 26,000 minus tax rate of 50%. So 10,000 and 13,000 is equal to earning after tax 10,000 and 13,000. Suppose number of sales you needed 10,000. So EPS is equal to EAT divided by number of sales. So 1 rupees and 1.3 rupees. For degree of operating leverage equal to contribution divided by EBIT 60,000 divided by 40,000 1.5. Suppose sales will be increase of 10%, EBIT will be increase of 15%. Degree of financial leverage formula is earning before interest and tax divided by earning before tax. 40,000 divided by 20,000. So degree of financial leverage is 2. Suppose EBIT will be increase of 15%. So EPS will be increase of 30%. Degree of combination leverage is equal to contribution divided by EBT, 60,000 divided by 20,000. So DCL is equal to 3. Sales will be increase of 10%, EPS will be increase of 13%. Another formula, degree of combination leverage is equal to degree of operating leverage multiplied degree of financial leverage. 1.5 multiplied 2 is equal to 3 is the degree of combination leverage. Financial leverage is a double-edged weapon. If also two edges can be used properly, then it can be a very safe weapon. But if it not used properly, then it will hurt a person using it. Favorable effect, suppose capital structure with the only equity share capital 5 lakh, profit is 1 lakh. The rate of dividend equal to profit divided by equity share capital. So 1 lakh divided by 5 lakh is equal to 20%. Suppose capital structure is a change. So equity share capital is 2,50,000, 10% debenture is a 2,50,000. Profit is a 1 lakh. So rate of dividend is equal to 75,000 divided by equity share capital 2,50,000 is equal to 30%. So use of debenture will be increase of rate of dividend of the 10%. Adverse effect, capital structure with the only equity share capital. Equity share capital is a 5 lakh. Operating profit is a 40,000. The rate of dividend is equal to 40,000 divided 5 lakh is equal to 8%. Capital structure will be equity share and debenture. The equity share capital 2 lakh 50,000, debenture 2 lakh 50,000. Operating profit is a 40,000. The rate of dividend is equal to 15,000 divided by 2 lakh 50,000 is a 6%. So this is the adverse effect. I am Ishwar Rathod.